On July 1st, 2014, the Department of Treasury and the IRS combined to approve the use of longevity annuities inside of qualified accounts. This could be the biggest news to hit the retirement income community and the saving community since the introduction of the Roth IRA. And just like the Roth IRA, when it was introduced, everyone knew it was a good deal. Anytime that the government gives you an opportunity to either save taxes, defer taxes, or completely eliminate taxes, you better believe it's a good deal and you should probably pay attention. But also, not everyone was familiar with it because the government doesn't do the best job of educating everyone out there. And things like this, just like the Roth IRA, there's not an opportunity for financial advisors to make much money. They're not going to talk about it as much, sadly as that is. It's just part of life. Anytime the advisor doesn't get paid a lot of money or have a real big opportunity, they're not going to talk about it as much. And that's not all advisors. That's the majority of them. There are some obviously very good advisors that always put people first and do their fiduciary responsibility, but not all of them do. And you're going to find a lot of similarities here between the QLAC and the Roth. And our bet is that 5 to 10 years from now, millions of people will have their money in these QLACs, these Qualified Longevity Annuity Contracts, and everyone will know what they are and the benefits of them, just like a Roth IRA. When Roths first came out, not everyone was dying to put money in. They didn't really understand them. And now, of course, it's just very common sense what a Roth is and the benefits of it. And of course, everyone wishes they had put money in a Roth for the most case back when they were first introduced. But we're hoping because of videos like this and education on this that you will have a better understanding about QLACs. And in fact, we're willing to bet if you watch this entire video from start to finish, you will know more than 99% of other Americans out there about these qualified longevity annuity contracts. In fact, you'll know more than the majority of financial advisors out there, just because many of them have not studied this because it is such a new concept. And also at the very end, you'll have an opportunity to download a free report by Stan the Annuity Man, the Wall Street Journal Market Watch columnist who writes all about annuities and kind of the nation's annuity expert out there is what we think of him as. And he's put a really cool report just for the people watching this video. It's completely for free at the very end. And we also have a couple little bonus facts as well. And also, I want to go on record before we start these top 10 must-know facts that QLACs, just like a Roth or anything out there that you can put money in, are not for everyone. And we're going to talk about who they're for and who they're not for. So this is going to be just the pros and the cons about these QLACs. So let's get right into it. Fact number 1. Let's first just talk about what a QLAC is, and just as important, what it's not. It is a fixed annuity contract that guarantees a future income stream at a date that you can specify, and it's very similar to having your own private pension plan. If you're familiar with a pension, you know that the company that you work for, the government entity, whatever it might be, they would kind of put money aside for you, and at a certain date you would get a lifetime income stream. Well, this is very similar, except of course you're funding it, which is why I say a private pension, and you have the control of when you want to take income and when you want to turn that lifetime income stream on. And what you're going to see here in these QLACs is that you can hold it all the way up to age 85, so you can defer it all the way up to age 85 before you take an income stream. We'll talk about that in a little bit. It is not a variable annuity. It is not a SPIA, a single premium immediate annuity. And those are the annuities that you think about that, hey, I give a carrier my money and they just start giving me an income stream right away, and I lose it all if I die early. That's not the case, and we'll talk about that in a little bit on a future fact. And it's not a fixed indexed annuity either. Fact number 2, not all longevity annuities are QLACs. This seems to confuse a lot of people. They're not all QLACs. Just because you hear someone has a longevity annuity does not mean they have a qualified longevity annuity contract. And once you own a longevity annuity, because the longevity annuities, by the way, have been out for about 10 years. In 2004, longevity annuities came out. And, deferred income annuities, they cannot be reclassified as a QLAC. So once you have a longevity, you cannot reclassify it. And QLACs can only be issued by large insurance carriers that have the reserve capabilities to meet the very stringent reserve requirements to back up these contractual guarantees. Fact number 3, these QLACs can potentially reduce your taxes. And we'll use this example in the next 2 facts. $500,000 you can defer the $125,000, that's your limit, under the current QLAC rules. Now, this amount can be deferred all the way until age 85. So the whole time that you're deferring that, you're avoiding having to pay the taxes on that. And then, of course, you can calculate your RMD, your required minimum distributions, that normally you have to take at age 70 and a half. And now you're having to calculate those on $375,000 instead of the full $500,000. So it's a huge, huge tax break. And we'll talk about that in fact number 4. These QLACs, as I mentioned, can lessen your RMDs. So on that previous $500,000 example, you're lessening what you owe in these required minimum distributions, which is the government basically coming back and taking your tax dollars that you've had at work and have had deferring this whole time. It lessens them in this case by $125,000 per person, because a spouse can also have one if they meet the requirements, of course. And all of this is assuming that you're able to hit the limit of the $125,000. That's not going to apply to everyone. Fact number 5, QLACs are not good for liquidity needs. This is obviously one of the negatives, and it could also be a positive if you don't want to have access to this money, or make sure that you are smart with your money and protect it. There is not good cash value in this. Now, don't let that confuse you to say that you're not going to be able to turn income. You can turn income, but this is not going to be the kind of annuity that you hold for 5 or 10 years and then walk away with some big lump sum and have a big return. This is meant for contractual lifetime income, and it also does not mean that you're just going to lose it if you die, which we'll talk about in a little bit. But please do know this is not something that you're going to use for taking out free withdrawals and using it for liquidity. That is one of the negatives. Fact number 6, QLACs can protect your principal. This is one of the biggest myths out there about this whole death benefit, and what we hear from consumers saying, gosh, why would I ever want a QLAC if I die, or if my spouse dies, or whatever it is, that all that money just goes to the insurance carrier and I lose. This is not a zero-sum game like going to a casino where either the house wins or you win. Of course, there are going to be some winners and losers based on how long you live, etc. But this is not an all or nothing where you're just putting all your chips in at one time. And let me give you an example real quick. If you did put $125,000 into a QLAC and you happen to die, let's just say it was 5 months down the road or a year to something really early, the rest of that money, all that money, that lump sum, it can go completely as a return of premium, assuming you have that in your plan, where a return of premium goes straight to your beneficiaries. So a full $125,000 could go to your beneficiaries. Or you could also have that 125 just go right to your spouse, so that your spouse, he or she, could then start taking an income stream themselves off of this. So that is completely incorrect when people think that all your principal and everything is just gone when you die. This is actually a great way to protect your principal. Fact number 7, there are no annual fees with these QLACs. This is another big misconception we hear from consumers that think, oh my gosh, that there's these crazy fees, because you hear about the horror stories that someone bought an annuity and they had to pay 3% fees every year. Those are usually considered variable annuities, sometimes fixed index annuities, but most all variable annuities, because there are security, they do have fees with them. These do not have fees, and there's a reason that variable annuities cannot be QLACs, as I mentioned to you earlier in this video. Variable annuities can never be QLACs, so make sure you know that if anyone ever tells you there's high fees, they're not fees. And I want to also tell you, this is something that probably many advisors don't want us talking about, but we need to tell all consumers this. There's very, very low commissions for the advisor or the insurance agent, which is a very good thing for you. That means it's a consumer-friendly product. So if you ever hear people talking about these high commissions, that does not apply to a QLAC. And that is sadly another reason you're not going to hear too many financial advisors pushing these QLACs, is because they hardly get paid on these things. Now, it's not always the case that the products you don't hear people talking about are always the best, but in this case, this is a very good thing. It's another reason the government has put a limit on how much you could put in there. This is a very, very incredibly powerful product. There's a reason there's a cap on it, and there's also a reason not many advisors are talking about it, is because they don't get paid that much. Fact number 8, QLACs are based on contractual guarantees only. This is a very, very good thing. Some of the other types of annuities, variable annuities, and even some indexed annuities, they're going to be based on other things, not always these contractual guarantees. And our friend Stan, the Annuity Man, who we mentioned earlier, he always says buy annuities for what they will do contractually, not what they might do. This is a very, very good thing. So when you buy a QLAC, you know exactly how much money based on an illustration the insurance carrier will show you, you're going to know exactly how much you could get any year that you happen to turn it on. That cannot change. It can only go higher based on some inflation things that you might add and some COLA adjustments that you might add on there, but it cannot deviate from what is on there contractually, which is what you want. Fact number 9, the longer you defer your income in your QLAC, the higher your lifetime income stream will be. And this makes sense, of course. The longer you let the insurance carrier hold your money and use it to their benefit as far as making money, the more they're going to reward you and give you back more. So if you can hold it to age 85 or 15 years deferral as a max for a traditional IRA, they're going to give you a higher payout than turning it on just after 1 or 2 years or at age 70, for instance. Fact number 10, QLACs do not allow indexing or mirroring of the stock market like a variable annuity or a fixed index annuity. And the variable annuity, as we mentioned, that's the one that can actually lose money, goes up and down with the market, and the fixed index annuity kind of mirrors the different indexes that it's attached to. And there's nothing wrong with variable annuities and fixed index annuities. Some of them are very, very good, and some of them have done very, very well when the market's up, but also can do very poorly when the market's down or have no performance at all. And it just goes back to that contractual guarantee. Make sure you know what you're having, and if an insurance agent or advisor starts talking about indexing or mirroring in a QLAC, you can just kind of shut them up and say, listen, I know that these QLACs don't allow indexing or mirroring, so what are you trying to sell me here? This is just all for your benefit. Now, some bonus facts. QLACs can be used in participating 401k plans, 403b plans, and even government 457b plans. They can be used in traditional IRAs, the non-Roth ones, and they cannot be used in any defined benefit plans, aka a pension, a Roth IRA, or inherited IRAs. And you can defer to a specific age as long as it is before the age 85. Some more bonus facts. On the premium limits, it's the 25% of the total amount of qualified counts or $125,000, whichever is less. And the $125,000 limit is an aggregate amount of all IRAs and plans for one individual. And as I mentioned earlier, if your spouse fits that criteria as well, he or she could also do a QLAC in their name up to that same limit. Now, when it comes to 401ks, 403bs, and 457b plans, the 25% limit applies to each participating plan with a $125,000 rule still in place. Now, what to do next? Next is download the QLAC Owner's Guide. I'm going to give you a link here in the next slide. It's the most comprehensive guide on QLACs out there. It's purely educational, and it really will answer any question, concern, or objection you might have on QLACs. And it'll even tell you who it's not for as well. And it's actually brought to you by Stan the Annuity Man, who's a Wall Street Journal Market Watch columnist. He's the annuity expert on About.com, featured in Wall Street Journal, USA Today, Fox Business, TheStreet.com, and Annuity 123, and he is the go-to expert nationwide on annuities, and really just tells it like it is, which is why everyone, all the consumers love him. A lot of financial advisors don't like him because he does tell it like it is and says, here's how much money people make on these, and here's why these are the best or the worst. And we really like and appreciate what Stan's done. So to get access to this high-content free report only for people watching this video, go to retirementthinktank.com/QLAC report, and you can have this thing emailed to you instantaneously. So retirementthinktank.com/QLAC report. Go there now, and we hope you enjoy the free report. Finally, if you like this video, make sure to like it below and subscribe to our channel for all of our future videos.